Ladies and gentlemen, our fascinating sessions during the day have focused on what we feel should be included in the EU jobs and growth agenda. In particular, the Commission's long-term financing and capital markets union initiatives. We have looked at which types of securitization deserve to be given regulatory preference and which types do not. How to remove structural problems in the EU economy, and how far we want to see the financial system rewired with collateral at its center, as opposed to a more traditional focus on credit risk. These are not easy questions, but I hope that we are slightly closer to understanding them, and in particular, their public interest dimension. I'm very grateful to all the participants for their thought-provoking contributions. As we approach the end of the formal part of today's conference, I would like to remind you briefly that there will be a drink reception outside the hall afterwards, at which you are all very welcome. But first, it gives me great pleasure to welcome our main keynote speaker for the day, someone who will help to shape, and it must be said, take responsibility for much of what we have been discussing. Ladies and gentlemen, please welcome the European Commissioner for Financial Stability, Financial Services, and Capital Markets, Commissioner Jonathan Hill.
Good afternoon, and thank you, Christophe. I'm very conscious, I've just been reminded, I'm standing between you and a drink and getting out of this very hot hall, so I will seek not to prolong that gap longer than I need to. But I'm very pleased to be here. I hope you've had a good day today. I'm looking forward to being told the findings and the conclusions that you've reached. First of all, I wanted to start by wishing Christophe well in his new role as Secretary-General of Finance Watch. And the reason I've called him Christophe is because before, when we were meeting, we had a long conversation about how best to pronounce his surname. And there were so many variants of Nijdam and the Dutch version and then an Armenian version that I thought I would settle for his Christian name. But he has an incredibly important job to do, and he's working for a very important organisation. We need Finance Watch to bring together a range of groups' interests in financial regulation. We need your input to the Commission's work. And I know how much my colleagues have appreciated the contribution that Finance Watch has made to our many initiatives, expert groups and consultations over the last few years. And overall, we need to hear the views of different parts of the market and different sections of society. And I'm sure that all of us here would agree that the finance industry is here to serve consumers, savers, businesses, and the wider community. And that's one of the reasons why Finance Watch was one of the very first organisations that I was pleased to meet when I first became Commissioner. Now, I think all of us want to encourage a financial sector that is built on strong foundations, has the right values, and which can underpin the economic growth that Europe so badly needs. And many of you in this room were involved in the development of the new rules introduced over the last 5 years to govern the financial sector. And you helped shape regulation that was essential to respond to the financial crisis and to help to restore financial stability. It was a remarkable achievement, made more so by the fact it had to be done while the fires of the financial crisis were raging. We need to remain focused on the threats to financial stability because financial stability remains the prerequisite to growth. And that's why I'm committed to finalising rules on bank structural reform, on money market funds and benchmarks, and to bringing forward new proposals to deal with risks arising from entities other than banks when they need to be resolved. But I think we also need to recognise that the nature of the threat that we face has changed. And today, I think you could argue that the greatest threat to stability we face is the lack of growth. GDP growth across the EU is anemic, only 0.3%. We have nearly 25 million people out of work. In many countries, there are genuine fears for a lost generation. And where that lack of growth and opportunity persists, a sense of hopelessness is creating a deeply worrying and corrosive cynicism about the ability of democratic politics to deliver. So there is not only an economic, but a democratic imperative to get our economies growing again and to build trust and restore hope for 500 million Europeans. So we need both financial stability and growth. We need sustainable growth. And that is the new Commission's number one priority. It's why President Juncker's first act as Commission President was to launch the €315 billion investment plan. We all know that jobs and growth will not come from politicians, but from the single market and from trade. But this plan can help by taking away some of the risk of investing in long-term projects, by supporting viable projects that might otherwise not have found investment, and by encouraging member states to remove red tape, regulatory bottlenecks, and other barriers to investment, providing the right conditions for the economy to get moving again. This relentless focus on jobs and growth also determines how I approach the decisions that it will be my job to take. I will look at all regulation through that prism of jobs and growth. And given that the worst of the financial crisis is behind us, we should not expect to have to legislate so much in the future. You shouldn't anticipate anything like the same volume of new legislation that the crisis called for. And after those busy 5 years of trying to moor the boat in a storm, I think we should also ask ourselves, have we always struck the right balance between reducing risk and encouraging growth? And if the evidence tells us that we haven't always got it right, if the rules are not proportionate to the risks presented by different types of operator, then I think we should be self-confident enough to look at the regulation again. Now, the issue of sustainable growth has been at the core of today's conference, and to me, sustainable growth means an environment in which companies can expand, entrepreneurs can reach new markets, and businesses can create more and better jobs, so that young people can have hope for their future, and all of us can thrive. A well-functioning and stable financial system is an essential prerequisite for growth. And we don't make the economy stronger by making our financial services weaker. We need to move from a position where the industry is seen as being part of the problem to one where it is seen as being part of the solution. How can I, in my mandate, help to achieve that? How can financial services contribute to growth? And I think there are two important ways in which they can help. The first is through a sound and stable banking system, one that is able to lend, keep people's savings secure, process payments, and generally deliver the services that consumers and businesses need every day. A huge amount of work has already been done to make sure that the right framework is in place to make that happen. And I'll continue to work hard to make sure that things stay on the right track. That means delivering detailed rules so that the reforms of the banking sector can be put into practice in day-to-day operations and looking at how the rules are being implemented and applied on the ground. I also want to try to ensure that compliance does not become a box-ticking exercise, but leads to a real change in culture. If we find wrongdoing, if professionals are found to have defrauded or deliberately misled unsuspecting customers, I think the system should come down on them like a ton of bricks. Now, the second way in which perhaps I can help is through well-functioning capital markets. These can spur growth through boosting confidence in Europe as a place to invest. Well-functioning capital markets can also help encourage greater diversity in funding, which reduces concentration of risk, so they not only free up capital for growth, but also support and strengthen financial stability. And it's important to remember that capital markets are not some abstract construct. They're someone's pension savings, someone's rainy day money, which then is channeled to growth. Building a single market for capital will help money flow through the EU to where it can be most productive. Its aim, at its most simple, is to link savings with growth. And this is a project for all 28 member states. My ambition is to help unlock the capital around Europe that is currently frozen and put it to work in support of Europe's businesses and perhaps particularly its SMEs. So I'd like to explain briefly what Capital Markets Union is intended to be and perhaps equally what it is not intended to be. With it, we want to remove the barriers that stand between investors' money and investment opportunities, to clear obstacles that are preventing those who need financing from reaching investors, and make the system for channeling those funds, the investment chain, as efficient as possible. Free movement of capital was, of course, one of the 4 fundamental principles on which the European Union was built. But 50 years on from the Treaty of Rome, we still don't have a fully functioning single market for capital. The market remains fragmented, largely along national lines, and overcoming that fragmentation could have significant benefits. To take one example, if our venture capital markets were as deep as those in the United States, as much as 90 billion euros of more in funds would have been available to companies in the period between 2008 and 2013. And just think of all the innovation that could have been sparked, all the new products and services that could have been dreamed up, all the new jobs that could have been created if the funding had been there. So our goal with the Capital Markets Union is to try to make Europe more attractive to inward investment. We also want to create more financing opportunities for SMEs and infrastructure projects, to spread risk more effectively to those who can bear it, and deepen integration across borders within the EU, increasing competition. What Capital Markets Union is not is an attack on banks. It is not about punishing one sector of the industry to reward another. I think we recognise very clearly the role that the banking system plays in Europe's economy and the contribution that banks make to local communities. Indeed, we envisage banks continuing to be an important distribution channel for market funding. So Capital Markets Union is more about growing the overall pot so that everyone benefits. Banks, capital markets, and most importantly, firms who can find more sources of funding, and giving more choice to companies on where and how they want to get their financing. Equally, Capital Markets Union is not another banking union. It will be different from, but complementary to, that project. Banking Union's focus was on breaking the link between bank failures and sovereigns through a single system of supervision and resolution. That will provide a platform of stability and confidence to underpin the development of a capital markets union across all 28 member states. But capital markets union is a response to a different problem, that of high levels of savings not finding their way to productive use in the economy. Capital markets union is also not just about the big players or big companies. It's about giving smaller businesses a wider range of options for their financing, so they're not only reliant on their local bank branch, but can consider options like listing on a growth market or attracting equity investment from outside their home countries. And it's about offering attractive alternatives to retail investors who want to save for their retirement and want to spread the risk between a number of different vehicles. So we think that it should be a great opportunity for the smaller players on both ends of the investment chain. And I think finally, Capital Markets Union will not mean a return to the bad old days of misregulation and excessive risk-taking. It'll be built on firm foundations of financial stability, namely the consistent implementation and enforcement of the single rule book that has largely been put in place in recent years. And we want to enable the economy to capitalise on a more diverse, more transparent and more resilient range of funding while remaining alert and vigilant to emerging risks. So how, a bit more concretely, will we build a capital markets union? Well, it's not going to happen overnight. It will be a long-term project that will require sustained effort over many years. And it will need to be approached from many different angles: securities laws, investment restrictions, tax treatments, insolvency regimes. These are all issues we've been grappling with in Europe for decades. But the urgency of our economic need is more pressing than ever, so I think we should not shy away from trying to address each of them. In the meantime, we've identified a number of areas where we can make some early progress in the coming months to encourage investment and to overcome obstacles. The first will be proposals to build a market for high-quality securitisation. We think that highly transparent, simple and standardised securitisation instruments can help free up banks' balance sheets so they can lend to households and businesses. And again, we've got no intention of returning to the unhealthy practices of the past. So far as the highly complex, opaque and risky securitisation instruments such as the subprime instruments are concerned, the door will remain firmly closed. But we need to be clear on where the problem was. The flawed products that were the catalyst for the financial crisis in the United States must not be allowed to return. However, European securitisations actually fared very well in the crisis. So why is it that securitisation levels in the US have completely recovered while the EU securitisations remain depressed? If SME securitisation could be returned safely, even to halfway back to the levels that they were at in 2007, that could be equivalent to some 20 billion euros of additional funding. Now, we in the Commission are not alone in wanting to breathe new life into securitisation markets. Both the European Central Bank and the Bank of England have consulted recently on high-quality securitisation. They too are interested in making sure that new securitized products adhere to higher standards. And again, it's a subject being discussed at the international level. I know that Finance Watch has some concerns regarding the potential for increased risk if there were to be a revival of securitization, and I share your views that we have to be vigilant towards this and other emerging risks. More generally, one of the steps we're taking to help safeguard against these risks is the Securities Financing Transaction Regulation, and this regulation will increase transparency so that investors and regulators understand how and where such transactions are being used, allowing us to act if needed. We intend to review the Prospectus Directive to make it easier for firms, particularly smaller ones, to access markets and reach investors across borders, while making sure that investors get all the information they need about what they're investing in. We are going to start work on improving the availability of SME credit information to help bring loans to smaller firms. And we'll be supporting the take-up of the new European long-term investment funds to channel investment in infrastructure and other long-term projects. In this regard, will move fast on the legislative measures that are needed to implement the legislation on these new funds, and will also assess whether it would be appropriate to extend the advantages currently available for national regimes to LTIFs, and will be encouraging EU institutions like the European Investment Bank to use these LTIFs to channel investment. We will be also supporting the industry in its development of a pan-European private placement regime. Private placements can offer firms a cost-effective way to raise funds. They can broaden the availability of finance for medium to large unlisted companies, and they could also potentially support infrastructure projects. So, ladies and gentlemen, I hope, we all share the same broad goals, namely to create a supportive environment in which funding can start flowing again and be put to productive use. One in which our businesses, especially the smaller ones, can grow and expand, and above all, one that will encourage job creation. Capital Markets Union will be one element in building that more growth-enhancing environment. It'll help promote investment in the economy, and to have a long-term impact on the ground, that extra investment needs to be accompanied by sustained efforts by member states to implement the structural reforms that their economies also desperately need. We're only at the beginning of the process of developing the Capital Markets Union. I'll be travelling around Europe in the next couple of months, meeting as many interested parties as possible to hear their views. We'll be launching a green paper on our plans within the next fortnight, and all of you in this room have, I believe, a crucial contribution to make. And I strongly encourage you and the organisations you represent to contribute to that green paper, to answer the questions that we put in it, and add any other views that you have, so that we can get as rounded a view as possible of the priorities and concerns of all users and participants in the financial system. For our economies, for our democracies, it's imperative that growth returns to Europe. It's up to us to prepare the ground, to provide a supply of water and ensure that when the seeds are planted, that they can flourish. Thank you very much.